Valuation methods. Friends, methods means how do we find fair value? What's the process? So we have two main methods to find fair valuation of the business, though there could be few more methods, but they're the two key methods we say. And what are those key methods? Two key methods to find fair value of any company, any stock. Valuation methods. Relative valuation. As the name suggests, friends, relative valuation is what? It is the value, it's the process of finding fair value by relating your company with other similar type of companies which are already priced in the market. So, this method is based on how other similar companies are priced in the market. Whereas, our second method, DCF valuation, intrinsic valuation. This method calculates fair value of the business based on its expected cash flows. Based on its expected cash flow, the cash flow this business is expected to earn over its entire life. Right? So, how much cash flow business will earn over its entire life in the future? This is what the basis of this valuation method. And because these cash flows are happening in the future, right? You're not getting all these cash flows today, right? When you're buying the stock, we need to find present value of those future cash flows, right? It means we need to discount those cash flows to present value. Friends, under relative valuation, we are not doing any projections of future cash flows over its entire life. The basis of valuation is simply comparison. Under this method, we try to find how majority of the companies in the same space are priced by the market. Here, we are relying on the market consensus. Though we are not relying on just one company's pricing, that company can be mispriced in the market. We look at the market consensus. We look at the majority of the company's pricing in the same space. Whereas under DCF valuation, we are relying on our own assumptions, our view about the company's future cash flow, because when it comes to the projection, then analyst role, analyst assumptions, perception about the company will play a dominant role here. So what analysts think about the future of the company, future growth, earnings, cash flows, margin expansion, etc., everything will be factored into this, and on this basis we try to find fair value of the business. That's why I call this relative valuation technique is more of a market based valuation. It's a market based valuation. Reason being, here the valuation is entirely dependent upon the market conditions. How the market is pricing same type of companies at any point of time, that becomes the basis of your valuation. As shown in the diagram, guys, to find the fair value of your target business, right? To find the fair value of a target business, as you can see on the screen, you have to find market price of other similar type of companies, same type of companies, as you can see. So, once you have decided the space, the comparable companies in the same space, then on the basis of market consensus, how the majority of the companies are priced, maybe median, maybe average, and maybe some other, benchmark multiple of the market, we try to find fair value of a target company. Here, market view plays an important role. What market think about valuation of a particular sector, particular industry, right? Whereas under DCF valuation, analyst view about business, about the growth of the business, about the fundamentals of the company will play an important role, because here analyst will decide about the future of the company. Analyst will take assumption about the future growth, which will be ultimately factored into your projected cash flows, and these projected cash flows will decide your valuation. Okay. So friends, these are the two main methods, key methods to find fair value of the business, and it's not about which method to apply. We try to find fair value of the business using both the methods, and we can relate both the methods at the end. So we'll see that process at the end, how both the methods can be related and how we can find, the value based on both the methods, which is justified as per current market conditions. Okay, so let's move to the next video, guys, where we'll discuss these methods in detail one by one, and then at the end we'll relate both these methods. Thank you.